Bernie Madoff didn't look like a criminal. He looked like the safest man in finance. For decades, he was one of the most trusted figures on Wall Street, a former NASDAQ chairman, a respected market maker, a mentor to regulators, and a quiet billionaire who didn't need publicity. And that's exactly how he pulled off the largest financial fraud in history. Not with flashy promises, not with hype, but with trust. Bernie Madoff built his image slowly and carefully. He ran a legitimate brokerage business that executed trades for major institutions. That real operation gave him credibility, offices, employees, compliance paperwork, and a spotless reputation. At the same time, behind closed doors, he ran something very different. A private investment operation that claimed to deliver steady, consistent profits year after year, regardless of market conditions. No big swings, no losses, just calm, reliable returns. In a world where volatility scares investors, that kind of stability felt like gold. Madoff didn't chase clients. Clients chased him. You couldn't just invest with Bernie Madoff, you had to be invited. This exclusivity made people trust him even more. If wealthy families, charities, hedge funds, and financial insiders were already in, then it had to be legitimate. Asking too many questions risked losing access, so most people didn't ask. Madoff claimed he used a sophisticated trading strategy. In reality, there was no strategy at all. There were no real trades, no real profits. He simply used new investor money to pay older investors, a classic Ponzi scheme hidden behind a professional facade. Fake account statements were generated every month, showing detailed but completely fictional transactions. Ironically, the system running this massive fraud wasn't advanced at all. It relied on an old IBM computer, outdated software, and fabricated records that no one properly verified. Simple tools, extraordinary damage. Madoff didn't raise all the money himself. Feeder funds, investment firms, and intermediaries collected billions from clients around the world and funneled it into Madoff's operation. Some failed to do due diligence, others ignored red flags. Some profited from the arrangement while passing risk downstream. Together, they amplified the scale of the fraud. By the time it ended, losses stretched across individuals, charities, pensions, and institutions worldwide. Not everyone was fooled. A financial analyst named Harry Markopolos repeatedly warned regulators that Madoff's returns were mathematically impossible. He submitted detailed reports, explained the inconsistencies, pointed out the red flags. But regulators couldn't imagine that someone so respected, someone inside the system, could be running such a massive fraud. Trust replaced skepticism. Oversight failed not because the signs weren't there, but because no one wanted to believe them. The illusion lasted until the 2008 financial crisis. As markets crashed, investors rushed to withdraw their money. Suddenly, Madoff needed billions in cash. But there was no cash because there were no real investments. Unable to keep the scheme going, Madoff finally confessed, not to regulators, but to his sons. They reported him. Within days, the FBI arrested Bernie Madoff. The safest man in finance was exposed as history's biggest financial criminal. Madoff pleaded guilty to multiple felony charges and sentenced to 150 years in prison. Investors lost tens of billions, charities collapsed, retirement funds vanished. The case triggered regulatory reforms, changes in whistleblower protections, and deep soul-searching across the financial world. Bernie Madoff became a symbol, not just of greed, but of systemic failure. This wasn't just a story about one man. It was a story about blind trust, about believing reputation over evidence, stability over scrutiny, familiar faces over uncomfortable questions. If something promises steady returns with no risk, If transparency is replaced with secrecy, if exclusivity is used to silence doubt, those aren't signs of genius. They're warning signs. Because the most dangerous scams don't look like scams at all. They look safe. And the best defense against them isn't intelligence or wealth. It's skepticism.